Comps make a deal look amazing, but comps don't tell you if the unit will actually stay rented. Today I'm breaking down a real deal I found online in Baltimore at 2668 West Franklin Street, and I'm going to compare it to a YourRentIntel.com report to see what the data suggests. Just to let you know, this video is just for education, not giving financial advice. Just want to show a real deal that I found on Facebook and see how it compares to YourRentIntel.com and the report that it generates. All right, so back to the deal I found on Facebook at 2668 West Franklin Street in Baltimore, Maryland. Let's take a where this home is located as we look at Google Maps. Looks definitely like a rental area, high traffic area, commercial properties across the street. All right, so this deal is being marketed for $80,000. After repair value, they're saying is $220,000 with a rehab of 20 to 30 grand, mostly cosmetic. 3-bed, 1-bath, between 14 and 1,500 square feet, row home. And they're claiming that the rent is $1,400 to $1,800 and is great for a BRRR deal, which is buy, renovate, refinance, repeat. So a deal can be technically accurate and still misleading. And to me, the question is, what rent is common, sustainable, and likely to stay occupied in this property area? All right, so let's take a look at the report. The report shows an estimated rent, YourRentIntel.com report, of $1,520 per month, rent ranging from $1,280 to $1,770. So that means $1,800 is pushing the very, very top of the rental market in this area. As we scroll down through market trends and AI analysis, we see comps. And most nearby comps are running between $1,300 and $1,450. And to me, these numbers may be a little bit more accurate than, $1,700, $1,800. And always keep in mind, the higher the rent means the higher vacancy risk that you assume as a landlord. All right, so as we scroll down, we'll see the vacancy rate is 36.2% and the rent to income is 43.61. So that's a very high vacancy rate, and the rent to income is definitely above the threshold of 30 to 35%. As we scroll back up to market trends, we'll see that properties are sitting for over 51 days. And as a real estate investor, to me, this suggests that leasing a home near $1,800 poses a very large vacancy risk. All right, based on the data from YourRentIntel.com, $1,500 looks realistic. $1,800 is possible, but that's top of the market, and that's pretty risky here. It would also, in my eyes, require a rehab as if you're going to sell the property, which leads to the after repair value number, the ARV. As we look back at the deal, they're saying the ARV is $220,000. And to me, that would need more data documentation. As the YourRentIntel.com report says, the property sale range at the top is around $120,000. And remember what the neighborhood looked like and what kind of street this property was on. So to me, this data suggests this deal can work, but only with conservative rent assumptions and conservative after repair value. And I would extremely take caution with the vacancy rate in any leasing situation. If you want this type of breakdown for your own deals, that's exactly what YourRentIntel.com is built for. Check us out on the web, YourRentIntel.com, or check us out on Facebook and Instagram. Talk to you soon.